Welcome, everyone, to the weekly stock market update. The real big issues are, should we be buying more stocks or should we be incredibly cautious? Those are the things I'm going to answer right now on this call. You know the drill. Let me know where you're from. And also, if this is your first time, we're also going to share on here some of the various polls, and I'll do some of that as well. Let's start off by sharing my whole screen, and I've got 100 slides. The ink is still wet on most of them. Let me know that you can indeed see and hear me loud and clear. Of course, that is incredibly important. New Zealand, Peter, thank you very much. And then I'm sure we've got a bunch of people, obviously, from the UK. Fantastic. First webinar, Martin, welcome from Kent to you, my friend. Newcastle, hello, London. It feels like almost Eurovision, global vision. Right, stock market update. Here we are. So I'm going to cover the main issues at the moment are, should we be looking at other countries other than the US? Is it time for Europe? Is it time for the UK? Are they significantly undervalued? What about some of the profits? Should we be taking them from some of the big tech companies? Should we be worried about overvaluation there? Or is it opportunity to buy something outside of big tech? Where are those opportunities as well? Remember, this is directed at investing, not trading. So we're looking at 12-month holdings on the whole. Right. First of all, look at where we are. Alphabet surged 10%, and closed with a stock market value above $2 trillion for the first time. Now, most of you might have thought, surely it already hit the $2 trillion mark. I have lost count. Anyway, it's worth more than $2 trillion. Do you remember there was a time when we would not even have imagined a company being worth $1 trillion, and how quickly they have gone from that to two? Well, I can tell you exactly how quickly. Since, well, this year. Sorry, last year. We're in 2024. Since last year. They've doubled in value. Has your business doubled in value in a year? Well, if you have, let me know, because I'm really impressed. Most businesses don't do that in the space of just a few months. They don't do that. Having said that, historically, Alphabet also halved in value and lost $1 trillion in 2022. And I'm going to come back to that later on. Wait a minute. I don't want my pension halving. It's all very well saying Alphabet's wonderful. Look how big it is. And these other stocks, the 3 A's and the 2 M's, Meta, Microsoft, Apple, Alphabet, Amazon. But wait a minute. I don't want my pension dropping 50%. Which it did. So we're going to address that issue as well. By the way, all the major banks say buy, buy, buy. Are they being over optimistic? What's my view? Do I hold it? Well, I do currently hold it. And it's a lot to do with its momentum. We don't just look at valuation. We don't just look at revenue growth, dividend yields. We certainly don't try and look at narrative stories. We want the data, the numbers. And the reason we don't look at narrative stories is, well, where the heck were the narrative stories in 2022? When it fell 50%. And don't tell me, oh, because people had turned negative on Alphabet. Actually, they turned negative on everything. So it had nothing to do with Alphabet dropping $1 trillion. And how can the market, which is supposed to be so efficient with information, be wrong by a whole blasted trillion? $1 trillion it was wrong by. I don't want my pension suffering just because a bunch of analysts have basically, quite frankly, simply got it wrong as they had then. Okay. So that's the reason why I've put it in those terms. Now I'm going to put a poll. Let's see. Now, first poll is about the FTSE. Okay, and then we'll do others. Suzanne from San Diego. I am so envious. Tunbridge Wells, Stephen. A little bit less envious of Tunbridge Wells. Derman from Surrey, welcome one and all. Nottingham, Staffordshire as well. So we're going to address those questions. How, in what are presumably really big safe companies which get phenomenal returns, we want the upside. We want that in our pension. We want to go up 100% in a year. But how do we mitigate against losing half the value? Like snakes and ladders. It's like snakes and ladders. How can we get the ladders and avoid the snakes? Is there an easy way? Okay, I'll give you another example. Look at NVIDIA. Right, look at point one. That's from the low point to the high. That went up 736% in 1 year, 5 months, and 2 weeks. Now, if you had a time machine, you would have got all of that gain. Okay, if you could see into the future and you had a crystal ball, you could have got all of that gain. I didn't get all of that gain. We only got in January 2023, so we missed a bit of the gain. However, there's a worry here. Wait a minute, Alpesh. To get that, everybody wants that 736%. Is it off the basis of narrative? Do you have to be an AI expert? Well, I'm not an AI expert. We didn't buy it because of that. We looked at the data. Okay, I'm going to show you some of the data. Whoops, here we go. I'm going to pull that up on the screen in a second. I'll show you some of the data we look at. Now, but wait a minute. Nobody wants 2. Look at point 2. Look at what I've marked at point 2. That's a 30% drop in just 3 weeks. Of course, nobody wants that. And we don't want to trade our investments. So given that we're probably not going to trade it and look at it every single day, and that might be a good thing, because if you happen to miss that dip, went on holiday and came back and it had gone and it had happened, and you think, whoa, there's something I missed, that's quite good. So how do we make sure we've got a process whereby we're not looking at something every single day, we're not trading the investments, but equally we're not panicking at a 30% drop, or whatever the right number is for a particular stock? And what is that number? And can this be done easily so that we don't have to be completely at the whim of the market and spending all our time doing this and not have any time to do the more important things in life, like smell the roses? Okay, so that's what we're going to talk about. Now, this is going to happen. We know that's going to happen. And the worrying thing is the answer isn't what it used to be. Trust the experts and the fund managers, as I'm going to show you in a second. And I'm going to go through the market at the moment and the various stocks. The biggest stock market falls in each of the past 50 calendar years. Okay, the last 50 calendar years, and the biggest stock market drops. Well, 10% happened 29 times. 20% dropped 13 times. Okay, that happens. It happens a lot. Right? That's going to happen. So how do we avoid that problem of, oh, I have to watch it all the time? And you might say, oh, the answer's simple. Just don't watch it, close your eyes, and just buy and hold. Well, like I said earlier, there's a problem with just buying and holding forever, because look at Meta. Went up for 6 years, then you lost 6 years of your pension, and that's not a little unknown company. Oh no, Alpesh, look, if you bought and held, look, it went back up. Look, see, over 2 years, it went back up. Yes, over 2 years, you got a 0% return. It went back to where it was. Wait a minute, that wiped out 6 years of your pension, and when it did rebound, you got 0% over 2 years. How about getting that 150% in the second year and not having that big drop in the first year? Is there a way of doing that? And so I'm going to come to some kind of suggestion, the happy balance that I have found in these things, which I've written about, and you can download a free copy of the book. I've written about how in one of my early books, Investing Unplugged, I've done 18. So I will cover that. What's the happy medium I found where I don't have to obsess over the markets, obsess over the investments, but at the same time can sidestep some of the big drops. It's not like I can walk between raindrops. I will get a little bit wet. It won't be getting right in at the bottom and out right at the top. There's no time machine or crystal ball, but it's enough. It's good enough. It's good enough. It's like an umbrella. Okay, it's good enough in the rain that you can avoid enough. So we'll address that. And we know we need to address that because some of the solutions you believe might apply don't. I'm going to come back to this chart, this slide a little bit later. And this has been one of my simpler solutions over the time. And I've not found a simpler one, but I will discuss it. There is another one where if it falls a certain percentage, X percent from the high since I've bought it, I'd sell Y percent. And usually that X, whether it's 10%, 15, 20, 25%, or 30%, is determined by my risk appetite, which is determined by this. And I'll give you some specific examples. So don't worry, you might sound a bit confusing at the moment, but I will show you what I mean in specifics. And this is important at the moment because we've got a whole load of people who have got triple-digit returns since January 2023 in some of the big tech companies. And their pensions are stonkingly high, and they don't want to give up some of those gains, as I didn't in my son's junior ISA when I sold Microsoft. So I'm going to explain all of that in this webinar as well. Of course, in the ideal stylized world, this is what would happen. We'd have two investments, which of course can go up and down. So we're not trying to pick stocks which only go up all the time, but are inversely correlated to each other, so that when you combine both, you get that purple line in the middle. Excuse me one second. So you get that purple line in the middle. That's the ideal. I'm sorry to say, when investment A falls, investment B tends to be correlated to it, even if it's in a different sector, a different geography, as I'm about to prove. So the ideal thing which IFAs will stick to, and thinking that it exists because this is what they learned in 1960s textbooks, no longer exists in an interconnected world. I'm sorry to say. If it did, I would love to do it. By the way, that image, that's how the biggest hedge funds in the world, and I certainly can't compete with them because the supercomputers they use, like Renaissance Capital by Jim Simons, AHL by Man Group, and the billions they manage, they're looking for those relationships. Exactly what you see on screen, and they take a ton of instruments to try and find things which might give this kind of correlation between each other. It's a bit more complicated than it actually looks, because sometimes it isn't causation, it's just they're uncorrelated. So they're just picking a load of uncorrelated stuff, which isn't exactly what we're talking about. Anyway, I'll come to some of this stuff a little bit later on. I went through some old slides that I used to have. This is one of them. Just be careful, men. Just be careful, men. Okay. Oh, that statistic, that poll, will FTSE be higher by the end of 2024? A minority of you think so. As many say yes, 38%, as say they are not sure. I might do one for the next elect. Actually, I will do that a little bit later on in terms of UK and US elections. Will the Dow be up by the end? Okay, so let's carry on a little bit. Now, this is something I was just at the university yesterday. That's not a photo from yesterday. It's all going off at the moment. So somebody's at my home. This is not from yesterday, but I wanted to, but I was in Oxford yesterday, and this slide was, when I was preparing this presentation, because I take a lot of time out of preparing these. Researchers in behavioral finance found that 39% of all new money committed to funds went into 10% of the funds with the best performance the prior year. What's happened in the prior year? The markets have done incredibly well. So people joining right now are going to say, oh, that manager did really well. Let's give him some more money. I am afraid that despite the evidence, this is a sure way to poor performance. I didn't say that. Somebody got the Nobel Prize in Economics, Eugene Fama, of those three people, who got that. Okay, when I was at that university, I used to read all their academic research. Then when I got a column in the Financial Times, I would publish this, and it came as a surprise to me as well. My point is, I don't believe in assumptions. I don't believe in narratives and stories. I believe in data, which is well researched. If you want to see the research on that, just Google Eugene Fama, the one at the top over there. So for those of you thinking, I know what the answer is, Alpesh, there might be a market fall, I'll just give it to last year's winners. Surely they must be really good. No. By the way, these are some of the things which have crossed my desk this week. So I'm going to share these, and then we're going to get into individual stocks and what I think was going on in markets. Range of equity and bond market returns, percentage annualized returns, 1950 to the present. Okay, range of equity and bond market returns. The range in any 1 year for large cap equities, and this is from JP Morgan Asset Management, okay? You can get anything from a 61% return since 1950 all the way down to losing 43%. Massive range, okay? Massive range, massive risk, right? But you'd rather have that. Now, of course, the longer you hold it, the less likelihood you're going to lose money or lose big. However, the smaller the annualized gain. And you might say, hang on, mate, 10-year rolling, 21% annualized total returns. I'll take that any time. The range is from -3 over a 10-year rolling period to 21%. So there's a problem with that. You could just happen to pick the bad 10 years where you got -3, and your neighbor started maybe a couple of years later, and his rolling 10 years was 21% return. Now, a lot of the IFAs will say to you, oh, look, longer you hold it, the less likely you're to lose money. Yeah, also the danger that you've just spent 20 years getting a 4% return, which is pretty rubbish. So how do you ensure that despite holding for a long period of time, whilst, yes, you're less likely to lose money, you're more likely to have a bigger return? Okay, a bigger return. You want to end up near the top of this range, not be one of those people who unfortunately picked a bad year and lost 43%. So how do we dodge the bad years? That's essentially what this graph is saying to me. It's saying not, oh, hold for a long time, you're less likely to lose money. Yeah, well, then I might, after 20 years of my life gone, have ended up with 4%, not the 18% annualized, the 4% annualized, which isn't obviously anywhere near as good. What this is screaming out to me is, okay, how do I avoid some of the worst drops in the market? That's what it's saying to me. Might be saying something different to you, and the IFA and the marketing spin will say, oh no, that just means buy and hold for a long time. Yeah, get your 0% and suck it up. No. Lose your 6 years of your pension like this in Meta, suck it up. No. What it's saying to me is, okay, is there anything I can do to miss even a little bit of this without getting out of the market prematurely and never getting back in, i.e. getting off the train and then watching it go and never getting back on the train? That's your fear, but making sure you're not on the train when there's a bloody train crash. Okay, that's the game. How do we do that without watching the market every day and without trading? That's what I'm going to answer. And I've sort of dove deep into it, or deep dived into it, on today's presentation. 25% drawdowns and subsequent returns. Well, here's a tiny bit of good news. Subsequent 12-month returns after 25% drawdowns. S&P 500 total return in US dollars. And it's pretty similar for the UK markets. JP Morgan's data. So 25% drawdown, subsequent return. When did we get a 25% drawdown? 2020, for instance. Subsequent 12-month return, over 60%. Whoa. Wow. 12 months after it fell 25%, you got a 60% return. Now, to an IFA, that says, oh yeah, that's why you buy and hold. Just hold it forever. Just hold it forever. No, to me, that says I still want to avoid those massive drops, because guess what? I want the upside without, obviously I can't get none of the drop, but at least miss some of it. Okay, that's what we're going to talk about today. This caught my eye as well. I mean, it's nothing new, nothing original on this. Asset class return risk trade-off. The average volatility for global equities is about 12%. Okay, by the way, the average volatility for Microsoft is roughly about 12%, probably the safest company I can think of. Just putting that to one side for a second. Okay, and the annualized return from 2004 to 2023 in global equities was 10%. Well, if I can miss, here's a theory from a young, ambitious man who, when he wrote this 25 years ago, was half the age he is now, and said to himself, wait a minute, if I can miss some of those downward moves without missing the big upward moves, and cherry pick some stocks based on the things that we know represent quality in a company, like trends and momentum and undervaluation and revenue growth and profit growth and dividend yields and good cash flow growth and consistent high performance, i.e. high Sortino, and outperformance when the market rises and outperformance when the market falls. If we can capture all of that, then can I do better than 10% per annum? If I'm cherry picking, because global equities there includes all the rubbish ones and the good ones. What if we get rid of some of the bad ones and get the academic research on that as well? Is there a way of improving that and just basically moving further up here? That's what I wanted. That's all I wanted. Can I just move a little bit up there? Because I know a 2, 3, 4, 5% rise will make a big difference. That's the goal. By the way, annual returns and intra-year declines. The biggest declines, so this is year to date, 2024. Okay, again, this is from JP Morgan. The annualized decline there is -4. That's the biggest peak to trough from the high point to the low point. And year to date, return year to date is 3% for the overall market. The average inter-year drop is 15.3%. The annual returns are positive in 26 out of 38 years. Now, again, you might say, well, that just tells me I should ride through the big drops because on average I will win. Well, like I said with this, and that's up to you. If you want to do that, if you can stomach losing 6 years of your pension within 12 months, this kind of drop on the basis it'll come back, and you might say, well, not everything's Meta. No, it's one of the biggest, most popular companies, and this is an extreme example, and I'll show the S&P in a second. If you can stomach that, it's entirely up to you. Then you don't even need to be at this webinar. All you need to do is buy and then hold until, until it's time to read your will. Basically, that's it. Most of us say, well, is there a way where I can just avoid losing 50% of my pension in a year with, say, Scottish Mortgage Investment Trust, which dropped 50% in a year, and so on and so forth. And those are extreme examples I'm giving, but guess what? Sod's law dictates it's the extreme examples that the one person who gets overconfident, like these two guys, gets the extreme example, right? Oh, by the way, and life expectancy, this makes it even more important to make sure we get our investments right. Probability of reaching ages 80 and 90. And by the way, feel free to take photos of these slides as I run through them at great speed. If you're a man, probability of person age 65 by gender and combined couple, what's the probability of reaching 80 years if you are a man? 67% once you've reached 65. What's the probability of reaching 90 if you're a man once you've reached 65? So you're 65 years old, you're a man. The probability of reaching 90 years is 24%. 1 in 4 of you will do it if you can get to 65. You might say, well, the trick's to get to 65 then, isn't it? Depends. But yeah, those are the statistics. In other words, we're living very long. And there's a high probability you're going to live quite long. So you're going to need the money for longer, and you're going to need more of it, in other words, or you're going to have to spend very little. Navigating market concentration, contribution of the largest 7 tech S&P companies to the S&P. This is their contribution of returns, 30%. Now, people sometimes show this and go, hang on, that it's the 7 big companies, which are these here, which are producing all the returns in the S&P. That's really bad. Well, no, not if, as we did for most of 2023, own all of these. We got out of Tesla in October of 2023, and I'll come to why in a second. I've only got out of Meta, Microsoft, and Apple, 50% of Apple this year in the last 2 or 3 weeks. So what do I care that they've been the biggest contributors? But wait a minute, more importantly, how do we find them? Not based on narrative, not based on, well, Alpesh must have a good gut instinct. He's written a lot of books, makes out as if he's clever, so maybe we'll just trust him. No. We want to look at the data. Because I don't trust me. I might be full of tons of cognitive biases, and I'm male. I checked this morning, and it reminded me I could be overconfident. So I look at the data, and you'd be shocked how often looking at the data, I bet you thought I was going to say how often I check. Looking at the data, that it's different to what I thought. I mean, I never knew NVIDIA was going to be this massive company. I first heard about them when their global head of marketing, Shankar Trivedi, is a friend of mine, was on the board of an organization I set up for entrepreneurs in 1999. That's when I first heard of them. And that's when he was on our board. I thought, oh, NVIDIA makes graphics cards, yeah. And I used to make my own computers back then because I needed them really ramped up. So I used to install these cards, which would come along and they'd say NVIDIA GeForce. I wish I thought about buying it then. I really wish I did. Never even crossed my tiny little brain. The point is, the numbers in January 2023 and in 2021 were phenomenal. Value, growth, income. So we'll come to some of those numbers in just a second. I'm going to show you, and some of you have been on my webinars before will know what I mean by those numbers and on what we look at and why it's important. Okay. So let's get this absolutely straight. I'm not an AI expert. I'm not actually an expert in any of those things. I'm a generalist. I'm not an AI cloud expert or even a tech expert by any means. Okay, equity valuations. Now, this is catching more and more of my eye in terms of the UK. FTSE All Share Forward PE, price earnings, is a measure of valuation. In other words, you're paying £11 for every pound of expected or forward profits or earnings a company generates. So imagine you've got a business and it generates £1 in profit every year. And next year it's expected also to generate £1 in profits. The analysts say so, you say so, everybody says so. And I say to you, I'll buy your business for £11. And you might say, it's only going to make £1 a year. Okay, I'll sell it to you for 11, Alpesh. That's what we mean by forward PE. Now, if I said to you, can I buy it for £2? You'd say, bugger off, Alpesh. You'll make your money back in 2 years. If I said, if you said to me, I'll sell it to you for £100, I'll say, bugger off, you only make £1 of profit a year. Do you see what I mean about valuation under and over? That's what we're talking about over there. So where are we? And this is just out of interest. Please don't read too much into this. UK sector, cheaper than the US if it's over here. This is the current, that's the average. The current is most UK sectors are cheaper than the US, with the exception of IT. Not so much, or industrials. Some of the cheapest are financials, UK financials, UK materials. Don't read too much into this. I look at company numbers, not sectors, because sectors hide good and bad companies. Yes, if the sector rises, surely the company is correlated to the sector that it's in, and it should rise to some extent. There are so many other factors. It's not as true as it used to be in insular economies, such as in the 1960s and 70s when most IFAs learnt their trade. Okay, now, how about valuations and subsequent returns? Now, again, sorry for being a bit geeky. I will get to the individual stocks, but I just got this from JP Morgan. I just really wanted to pick out of their 100-odd pages the most important ones. Where are we at the moment? Okay, forward PE ratios and subsequent one-year returns. So where are we at the moment? We're here. At the moment, we're paying about $22 for every expected dollar in future profits from the S&P 500, the 500 largest American companies. We're expecting them to generate $1 in profits in the future, and we're willing to pay $22, or I think it's about $21 for that, right? $21 we're willing to pay. Why are we willing to pay so much more for American companies than UK ones? Well, if you're British, work it out. Come on. Now, what's the next year returns when we're willing to pay that much money? There are some years where we've been willing to pay very little because we think things are really bad. So what is the next year return? Actually, most times, the next 12 months, the return is somewhere between -0 and -25%. But there are some good years where you can get as much as 20%. Okay. And you might say, well, actually, there are quite a few years where even when it's more expensive than that, you can get between 20 to 40%. So don't panic, Alpesh. What I would say is we need to focus a bit more on the potential downside at the moment, because as we can see, when it's so expensive, we might want to sidestep the market till it gets a bit cheaper here when there's greater likelihood we're going to get a 40% year. Okay, so what I'm trying to say is last year, the S&P was up 25%. The NASDAQ was up 55%. The year before, the S&P was down. We need to sidestep some of the bad years. If we can sidestep the bad years, and we're well aware of it, or even part of those years, we'll save ourselves a lot, because we want to try and capture as much of this and avoid as much. We won't ever be perfect. We'll never be perfect. Avoid as much of that as possible. I won't go into this in too much. Bull and bear markets, the percentages, durations, and the price returns, 41%, 103%, 36%. We want that. Look at some of those. It's those periods our pensions go up. Now, this is the other thing which people get wrong. They think the stock market's meant to be like a bank account. Oh, well, I average 20%. No. You get a year where you get 80%, and you get a year where you get 0%. It's a wide band. It's not where, oh, you know, that means you average 40% then, don't you, Alpesh? Well, yeah, technically, but what bloody use is saying that? If one year you got 80 and the last year you got 0, Yeah, your average is 40, but that's not very blooming useful. Unless some of you think, oh, yeah, I think that's really helpful. I don't think that's helpful. So we've got to, again, try and avoid some of this downside. So I just wanted to share these slides with you before I go into all the individual stocks as well. And by the way, yes, we're expensive on that. There it is. It's roughly there. Average has been 26.6 for the valuation measure for the S&P. We're currently at 34. Yes, we're expensive. Price to book, which is Warren Buffett's favorite, is 3.1 times. That, in other words, you look at the book value. What would you get for a company if you basically fire sold it today? That's its book value. What would be somebody willing to pay for all its assets? They're willing to pay $1 for it. You're willing to pay 3 times the value, the book value of it. So it's worth $1. You're willing to pay 3. Why would you be willing to pay 3? Well, because you can do something with it and earn money with it. That's the book value. The latest is 4.5. In other words, it's expensive. If people are willing to pay ever larger amounts, either they're very optimistic about the future and profits, which may well be the case, and it is at the moment, or they're getting a bit too over optimistic and it's time to get ready for some of the snakes to come in and protect our downside. Okay, but we don't want to get out prematurely. That's what I'm talking about here. So where are we on valuations? As I said, okay, the Microsoft, people are willing to pay $29 for every future dollar of profits in Microsoft. In Amazon, they're willing to pay $31. However, the cheap ones are energy, healthcare, telecoms, and financials. Well, should we just put our money in those? No, because valuation is not the only thing that moves stock prices. For a start, momentum moves stock prices. Use your common sense and your knowledge about the markets. You'll know that that's a factor. Revenue growth is a factor. We know cash flow is a factor. There's a lot of factors, not just valuation. So in this presentation, we're going to go through all of these ones: Meta, Nvidia, Apple, Microsoft, NASDAQ, S&P, Amazon, and we'll look at some of the UK companies as well, Alphabet. Okay, now, as you know, I look at the data. So I want to look at value, growth, income, value, growth, and dividend yields, cash return on capital invested for companies, momentum over the last 6 months. Sortino means high average returns and consistently hitting it, i.e. low risk or volatility of missing it to the downside. Alpha means market goes up, you got more, market falls, you also go up more. And what I do with that, and here's a bunch of, that's a database of 10,000 equities. By the way, none of these meet my criteria because all 5 of these columns have to be green, and nothing I'm showing you on my screen meets my criteria. So look at all the companies out of 10,000 that don't, which is just as well, because you tighten your criteria until you get the right number for your portfolio. I mean, you're not going to hold 10,000 stocks, so you might as well have criteria, which narrows it down to about 50 companies, because you really want to pick the best 20 out of that. So we'll come back to that process a little bit later on. I look at the data, because God knows I can't go through 10,000 companies and be an expert on every single one and read their narratives and their reports and earnings statements. And as Warren Buffett says, what does speaking to the company ever do to you? I mean, they're only going to say how wonderful they are. So how was the past week in the markets? Well, some of the healthcare ones did well. Look at all these undervalued ones we said that didn't do anything, and energy didn't do anything. So much for that being undervalued. That didn't help. Ooh, Tesla's had a bit of a spark, and you could say, well, that's because he went to China. Well, unless you're a pilot for Elon Musk's private jet, you didn't know that. So we're not going to gamble either on speculation like that, are we? We'd have to pick it only based on data, which academia shows works and is replicable. Not, you know what I'm going to do? I'm going to try and get some inside information from Elon Musk's private pilot. That ain't going to be the way we're going to do it. Okay. And by the way, some hedge funds do try and do that. Semiconductors did incredibly well again. Well, wait a minute. Is that a flash in the pan? What is it? Paul, it didn't come up in the Telegram private channel. It's a public one. The private one is recorded privately later on for the Great Investments Program people. That speak to... Well, sorry, it did come up in the private one. I think I put it in the wrong one. Should have gone in the public one. The private one will come up later. I've just deleted the private one. The public one is this, and the private one will come up later tonight. Okay, so ETF 1 month performance Nothing much I'm going to say because I'm not going to talk about ETFs at the moment on this. We looked and saw quite a few India ones come up because of recent momentum. They're looking a bit overbought. So I worry that after the election ends, is it next month it ends in India, that the market might fall off a bit. Buy the rumor, sell the fact. I mean, it's pretty certain who's going to win. The Chinese ones weren't coming up either. I was expecting them to. There's a bit of momentum. Individual stocks listed in the United States from China were. So I can talk about those a bit later on. Markets year to date. S&P is up 5%. The UK is up nearly 5%. That's very unusual. So you could, if you were that way inclined, you could go long the S&P and short the FTSE. The Nasdaq's up 3.69. Very unusual for the Nasdaq to be underperforming the UK, and the Dow is almost flat. Again, very unusual to be in that way down, and we'll address that in a second. So what's been generating the results? Energy is right up there. Financials, consumer, industrials, utilities is up there as well. Tech actually hasn't been that great. It's almost flat this year, funnily enough, despite what you might think from reading the news. It's all tech. It's not actually. It's all energy. Sorry, Greta. It's energy. And there's talk that we should ditch net zero in different parts of the world. Sorry, Alok Sharma, Sir Alok Sharma. How about the factors which are moving things? Growth. Revenue growth and profit growth have been the most important factors, not undervaluation, as you saw. Undervalued companies weren't the best performers. Okay, momentum has been an important factor as well. As you know, when I'm selecting stocks, I don't try and gamble on which sectors like this or which factors. I pick companies, so I ignore sectors completely. I pick companies, whichever sector they might be in, which tick all of these boxes, so that should it be growth that's winning, well, I know I'll only have growth companies. Not all of the companies I'll have will be solely growth. There'll have to be growth companies which are undervalued and show strong momentum, because we're only picking from that subset. Okay, they have to tick all of the boxes. That way we must necessarily have growth companies which have gone up. So that's how we mitigate downside risk. What about 1 year? Well, that's more normal. Nasdaq's up 31%. Hopefully your pension is up 31% over the last 12 months. The S&P is up 20%. Hopefully your pension's up 20% over the last 12 months. The Dow, which is just 30 companies, of course, is up 10%. Hopefully your pension's up 10%. Well, hopefully it's not. Hopefully it's done better given the market environment. And the UK markets are up 6%, which is quite high for the UK markets over a 1 year period. But it is common for them to be at the bottom of this table. When you look at the Nasdaq, which is, of course, an index, the S&P, is an exchange. The Nasdaq is an exchange. The S&P 500 is an index, and the Dow is an index of the 30 American companies chosen by, I don't know, I think the Dow Jones Industrial Average Committee of middle-aged men who decide which 30 will go in there. And I think they've just added Amazon, or are about to add Amazon, because they think the internet might not be a fad. They've come to that conclusion recently. So that's the Dow. It's not by size. S&P 500 is by size. The Dow isn't, unlike the FTSE. All these indices are developed in different ways. The Dow was actually invented, 130 years ago, to be representative of the United States. S&P 500 over the past month, those are the best performers. Well, there's Alphabet, familiar name. There's two versions, obviously, of Google stock. There's the voting rights one and the non-voting. They're neither here nor there. I mean, that's okay. You might say, well, wait a minute, Alpesh, there's nearly 0.5% difference between the two of them. It comes out in the wash. Sometimes one of them's better than the other. Bottom 10 S&P 500 stocks. There are those. And price 1 month ago on the FTSE 100. Is that interesting? The brokerage is doing rather well. I guess the private investors going nuts, and some of the worst performing over the last month have done that in the FTSE 350. I walked through JD Sports today, actually. They had loads of these Adidas trainers that the Prime Minister had been wearing. I wasn't shopping. It was the only way to get out of the mall area that I was in. Anyway, by the way, just be careful with name recognition. If you think the answer is, well, these funds have done really well. This is the price 6 months ago of, well, that's UBS, names you'll have heard of. That's Bailey Gifford. That's M&G. That's MGI. Quite a few of the property ones not doing too well. That's China. I will pick the other end in a second, the top end. That's Invesco, and it's China Health, and that's China, and that's in the last 6 months. Let's look then in the last 6 months of the ones at the other end, which have done rather well. Well, I want you to be a bit careful here. Remember I said chasing momentum when it comes to funds? Yeah, these ones have gone up that much in 6 months. Actually, what you want to ask your IFA and your fund managers, how did you do in 2022, which was a down year? How did you do? Because presumably, come on. There we go. Presumably, that's the year when they're supposed to pay for their fees. You see, when the market's rising, all boats rise in a rising tide. When the tide goes out, as Warren Buffett says, that's when you find out who's swimming without any trunks on, any shorts on. That's when you need the manager. That's when you need the skills. How do you decide when to exit? Now, like I said, I've got a couple of rules. One is if it falls 25% from the high since I bought it, that can be a good rule just to leave somebody. If you bump into somebody at Starbucks and they go, well, I don't know when to get out of Meta. If it drops 25% from the peak, sell it. I'm never seeing you again. It's as good a rule as any. Okay, but if you've got somebody who's a bit more savvy, you might say to them, well, watch my weekly broadcast, or you might say to them, if the monthly MACD falls below its moving average, I certainly don't want to be holding it. And if you're more risk averse than the 25% drop, you might say, well, if it drops 10%, I'll sell Y% based on my risk appetite. If it falls 15, I'll sell Z. If it falls 25, I'll sell Y, etc., etc., etc. Okay, so you could make it prescriptive. I mean, that's a pretty good way to start. What I'm saying to you by looking at this is that's when you want your manager. I don't care about how they did in the last 6 months, because I just asked them how they did in 2022, when we ended up having to hold cash most of the year for the very simple reason. If you follow my Telegram, you'll see in January I said, well, I'll wait till February's lists. February I said March. March I said April. April I said May. May I said June. June I said July. And then in July we bought some energy stocks. I didn't know it was going to be such a bad year. But thank God we sidestepped it. Okay, so that's one point. The other thing I want to say is, and by the way, this is UK companies. You might think, oh, that's all right, Alpesh. That's just America, which was down in 2022. I'm diversified, Alpesh. I bought a load of British companies. Well, that's how they did in 2022. Moonpig, it's my anniversary on Friday. We just used Moonpig to buy my wife a card. Okay. Aiden, perfectly fine. Phil, private monthly comes up. Please put them in the private group as well, as it's easy to miss from the slides. Understood, Phil. Why are many renewable companies and funds doing so poorly? Not sure. Don't know. I'm not a renewable energy expert. It's an interesting question to ask a renewable energy expert. 70%. These are names you've heard of. So much for buy and hold. Okay. I'm not picking on them. I'm just saying that. So let's say you had a fund manager who had all this diversification. Great. Okay, well, let's look at this then. That's 2022. That's the US. Oh, it's okay, Alpesh. I didn't go into those UK companies. UK rubbish. I went into US. Well, no. Those are US companies, which are well known. Right? Those are US. Okay. That doesn't help much. I know, and we had somebody sign up from Norway today. I'll go into Norwegian companies. That's diversified. They can't have anything to do with the UK or US. Well, sorry, that's 2022. That's not to say you shouldn't invest. That's to say we want to make sure that out of every 7 years, when we get 1 or 2 bad years, like 2022, we are just keeping an eye out 5 minutes every 2 weeks, just checking the pension, just making sure if anything's fallen, like a CVS or whatever, and so, yeah, we're going to have to get out of it. Out of 20 stocks, I'd expect 2 at least will drop 25% from the peak. What are your thoughts on CVS? I've not looked at it today. I don't have new thoughts on a company. It's the data. If the data says it's dropped 25% from the peak, then that's it. Okay, I'll get out. Sometimes I might extend that to 30% if it's a volatile company. If it's more volatile, then I might say, okay, right, it's a more volatile company. How can you tell if it's a more volatile company? Well, you look at drawdown danger. You just look at historically when the market's risen, like here, how deep has been the drawdown, i.e. how deeply has it fallen from peak to trough in a rising market, i.e. rising monthly MACD. Let me get rid of the weekly one. When that's rising, how deeply has it fallen and for what duration? How many months? Simple as that. And I said, well, actually, falling 13% is unusual. That was a falling market, so that wouldn't count. That's 43%. Okay. That'll be a good way. So you might extend it from 25 to 30, maybe even 35, but I wouldn't go beyond 50% because then you might as well not have any protection at all. So 25, 30, maybe even 35 in exceptional circumstances, but 50, no. Okay. And that happens. Great. So what? What about indices? Would they have protected us? Well, no, that was 2022 as well. And those are pretty horrific results for indices, as I've said with that. So let's look at the S&P right now. So what's happening? Well, the weekly MACD is falling. The monthly is rising. What does that mean? Well, that means we're at a period like this, which is what we had in last year, which was one of the best years in the market ever. That's what we've got at the moment. We've got that fall. Does that mean we're going to replicate last year and have one of the greatest years in the market ever? No, it doesn't mean that at all. All it means is the weekly MACD is falling. The monthly, if it's rising, great. If it's going sideways, amber alert. If it's falling, double amber alert. If it falls below its moving average, then I don't want to be in. And is the monthly doing that at the moment? No. Is the weekly falling? Yes. What does that mean? It means short-term drops. Like this, it'll be more like this than where it's 12 months get into cash. So this doesn't tell me to get into cash. What it tells me is if I've got some big gains, I might want to reduce some of my equity exposure, might hold more cash rather than go totally into cash. As then we sold, if you remember, Tesla, for instance, some of the special situations, which in January had made great gains, some of the weaker holdings. So what the hell's a weaker holding? Weekly MACD is falling through its own moving average is a weaker holding. But certainly never want to hold anything where the monthly MACD is below its own moving average. So you get in based upon fundamentals. You're getting out based upon statistics of drops, 25% drop, or if you want to be sophisticated, not just have a 25% drop or a 10% drop or a 15, you would say, okay, then I'll be more sophisticated and I'll look at these indicators. But I don't want to look at those, Alpesh. Well, in that case, fine. If it drops X, sell Y. If you drop 10%, work out what your risk appetite is. How do you work out your risk appetite? Just look at what it did in up previous rising markets and what was its drawdown, depth, and duration. It's as simple as that. Put simply, basically, if the weekly and the monthly are rising, you are going to the races. I wish I only had those stocks. If the weekly's rising but the monthly's falling, that's what's going to happen over the short and long term, and so on. And if they're both falling, then you certainly don't want to be in if the monthly is going below its own moving average like that. I mean, that tells you everything. So at the moment, yeah, why did I sell some, which I'll come to in a moment? Why did I sell some of my holdings? Well, because I think it's going to be like this. Well, why did you not just sit through it? Well, because if you've had big gains, as in Microsoft or Meta or Apple since January 2023, and you're sitting on 2 times leverage in the case of some of them, then yeah, you might want to take a bit of money off the table. Why not go totally into cash then? Because I don't like trading my investments and because the monthly hasn't fallen below its moving average like it did then. So it's specific to my risk appetite. Yours might be different. What I would suggest to you is, even if yours is different, try not to hold things beyond, in the case of individual stocks, below a 25% drop from the high, unless, as I said, historically, it has deeper drops in an upward market. And certainly try not to hold it when the monthly has fallen below its moving average from an oversold position like that. Okay, so risk appetite, don't care what you do in your risk appetite, as long as those 2 rules that I just said, you try to keep to please. And you only need to watch your portfolio once a fortnight to check on all of that. I mean, more frequently if you wish, but try not to trade your investments. UK at the moment showing a bit of momentum. My only concern is in the past when it's shown that kind of momentum, it doesn't last and then gets exasperated and falls off again. The NASDAQ, as I said, well, I just showed you the S&P, and it's highly, it follows that. Well, look, if the MACD is rising like here, great, you're off to the races. If it's going sideways like it was here, then you'll get a short-term dip usually. And if it's rising there, you're fine. So rising, good, amber alert, drop, closes below its moving average, get the hell out of there. So basically, you don't care unless this. That's what you're watching out for. That. Everything else, you couldn't really care less and could sleep through it. Hi, Alpesh. How do you put monthly MACD on the weekly chart? You need websites that will do that. That's how you do it. Joanna, do you invest distributions only and reinvest the gains? It varies. I mean, it's better to reinvest. Basically, it's better to invest more money than less if you're going to get a positive expected return. Apple, as you know, I sold half of because the MACD had fallen below its own moving average. Why did you only sell half and not all of it? Well, it's one of my quality five, the two M's and the three A's, Meta, Microsoft, Apple, Amazon, Alphabet. What do you mean by quality five? I mean, those which I'll watch every week. And since 2016, when I looked at what happened in the last financial crisis in 2008, which I expected in 2016 to repeat itself, but it didn't. So these were the flight to safety companies, which were the best return ones in the case of a nuclear meltdown. So they're the quality five, I call them, where I presume even if I get out, I will get back in at some point. So I've sold 50% of it, which I'm happy to do. And I'll decide when I get back in. But at the moment, it's Wednesday. We'll wait till Friday. I don't think I'll be getting in on Friday. So the other 50 I'm continuing to hold. Would I buy more at this price? No, I'd rather wait. Alphabet, I still own. My son owns 2 times leverage in this still. Yeah. For those on the private program, sorry you got the link. Paul, apologies, I got it wrong. On the private Telegram for this webinar, because you'll get your bespoke 200-slide presentation tonight, which will be a lot longer than... won't necessarily be longer than this, actually. Microsoft. Now, why did I sell that? Alpesh, why did you sell it? Why did you sell it? Well, it was personal to me. It's not because I had some inside information that Microsoft's going to fall or anything. And I do expect I'll buy it at some point in the future. And I don't think it's going to do this kind of a size drop for a long period. I think the drop will be more like this. I anticipate I'll be buying back in a few weeks. But the reason I got out is because having got in, and as you will know, if you follow my broadcast, January 2023, I was sitting on, especially with my son, 2 times leverage on this as well, that even a small drop in Microsoft, like 1%, was costing him tens of thousands of pounds in his junior ISA. And he's only 6 years old, and he doesn't know that he's not actually going to get that as an inheritance, and daddy's going to blow it all on wine, women, and dance in Bali. But for my own sake, I thought, I'll get rid of some of it. Now, you might say, well, I don't want to do what you're doing. Alpesh, I don't care what you do. Good. You should be independently minded. And what I would say to you is what I said. The monthly MACD has not fallen below its moving average, so you don't need to worry. It's certainly not dropped 25% from the peak, at which point you might even buy more. But I'd say be wary of that. If it falls below its monthly moving average, the weekly is falling, so you can see that it's probably going to be closer to this kind of thing where it has a few falling weeks. And I just wanted to pocket some money. Okay, don't forget, with the quality 5, I buy up to 15% on the unleveraged of my overall assets go into that. So it's not just 20 stocks, 5% each. It can be 15% in any of the quality 5. So I'd had the 15% starting point in January 2023 plus 2 times leverage. And my wife's portfolio, for the lack of bureaucracy, mimics my son's. So there was a hell of a lot of exposure that the Patel family had to Microsoft alone. And I thought, let's take some of that out. And you might say, well, you shouldn't have. You should have only sold half or 25%. You're probably right, okay? Because the monthly hadn't fallen below, and it's not fallen that much. But like I said, if it falls X, sell Y. Now, with a time machine and a crystal ball, I'll be able to tell you in hindsight what I should have done. But since I don't have hindsight, I didn't. Amazon, just so you know, I continue holding. Disney, continue holding, and that's where it is. Similar patterns to many of the others. Don't forget, on YouTube, you've got a whole bunch of new videos. I've done about 3 or 4 in the last 2 days alone. Now, NVIDIA is another classic example. It's overbought. Okay, why did I get out of it? Well, because what I saw in the S&P and all of these, I thought, let's just take a bit of money. Alpesh, for personal reasons, wanted to pocket some money. Now, when should I have got out of it? You might say, well, I'd certainly not want to hold it if the monthly falls below its own moving average. Has it done that? No. So why did you get out prematurely? My son wanted a Ferrari. What do you want me to say? He wanted a new private jet. What I'm saying to you is my personal appetite will be different to yours. However, there will be a point where I say to you, I really wouldn't want this, which is if the monthly moving average falls below its if the MACD falls below its own moving average like that. So at the moment, you might say, well, I'm not going to follow you, Alpesh, because my son doesn't want a Ferrari, my 6-year-old. So I'm going to wait. If it drops X percent, say 10 or 15 or 20 or 25, I'm going to put how much I'm going to sell according to those based on my appetite. Now, if you and I go out for dinner, my appetite is going to be different to yours. All I would say to you is, please don't hold it when that happens. It's up to you, but you don't have to. You can read it in the book why. I mean, 25 years, it's not done me too bad. And try not to hold things unless you've got very good reasons when they've fallen 25% from the peak. And a very good reason might be, it's quite common for this kind of stock to have that kind of drawdown depth of fall from peak to trough in an upward move. Okay. And if it's not common in an upward move, upward meaning the MACD's rising, okay, which is that period, not common to drop 25% from a peak to trough, then why are you holding it at that point? Tesla, as you know, well, there it is. It popped up a bit. We sold in October of last year. It had risen from our January holding till about, I think it was here. When was October? Oh, no, that's not October. This is October. Until then. And then it went up after I sold it. And then, of course, it dropped. Alpesh, has it turned around? Well, I'm looking at this because this is a market update. So I'm looking at Tesla as well for you. I'll answer the other questions in a second. Ed, you can use Yahoo Finance completely for free to look at the weekly and the monthly MACDs, just not on the same chart simultaneously. For this, I've used Trend Spider. If you want to spend £1,000 a year on Trend Spider, I don't own it. I wish I did, because then you'd be paying me £1,000 a year. Then do. But Yahoo Finance, you can do it for free. You just can't put the weekly and the monthly on at the same time. You've got to toggle between them. It's free, though. Okay? So that's what you can do. Now, with this, I'm just updating you. I don't own it. I won't buy it now. Meta, as you know, I exited alongside Microsoft. On the private channel, I'll say more about that. NXP Semiconductor. Now, this is unusual with some stocks. What's happening at the moment is, unlike in 2022, when the whole market was falling and they were all doing this kind of pattern, the monthly and the weekly were both falling. At the moment, what's happening, that is happening with some, but not with all. Some of the others are like this, where the monthly's rising and the weekly is sometimes rising, sometimes sideways, sometimes falling. But as long as the monthly's rising, that's why I'm not completely in cash at the moment, because there are some good companies just waiting to hold out for them. You might get a bit of choppy turbulence with these, as you can see. Okay, some stocks are like that. And by the way, if you don't like turbulence, and look at that, then avoid companies where in the past the drawdown danger in an upward move can be quite deep. Okay. Oh, Gurdeep, that's interesting. TradingView allows MACD weekly and monthly simultaneously for free. I'll look into that. Thank you very much. People can use that. Oops, I'll close the poll. That's very helpful, Gurdeep. Thank you. A lot of people find TradingView rather good. I've got no criticism of it whatsoever because I hear it is rather good. I've never used it for no other reason than I can't use everything. But I might give it another revisit, actually. When I was writing my Financial Times column, I would try and pick out good, useful websites. And I'm still addicted to providing good, useful websites. My favorite website of all time was a website called Riskmetrics, which was produced by JP Morgan. Sadly, they closed it down. And it was free as well. Anyway, Qualcomm, what can I say? The monthly MACD is up, the weekly is falling, so you'll get a bit of sideways move for a bit. I continue holding it. Netflix, I never bought, remember, but I covered because it's popular, and this is a market sentiment webinar, so it's done incredibly well. Do I wish I bought it? Well, yeah, it's gone up, so but it's not one I bought. By the way, why didn't I buy it? For no other reason than I can't buy everything. So not one I ever bought. What about now? Well, same rules I'm going to give you. That hasn't happened. So if you're risk loving, you could wait holding it. If you're more risk averse, you'll say, bugger that, Alpesh, I'm getting out if the weekly just falls from an overbought position from and crosses below its moving average. Do you see what I mean? If you're risk loving, you will wait for the monthly to cross below its moving average. If you're risk averse, you'll just get out on the weekly. Well, what's the danger of being risk averse? So risk averse, well, you might get out prematurely. That's it. That's the risk. And that's a pretty big risk because look, it would mean here you would have got out prematurely and missed all of that. And you might say, no, because I could get back in if it goes back up again. Well, then you're trading, and that's fine, but make sure you've got a good trading strategy and develop one for yourself. And that's perfectly fine. You could say, well, I'll get in and out, and that's very time consuming. Okay, so that's why, on the whole, I tend not to trade my investments, because I can't waste the time on trading investments. I trade trades, but I don't trade investments. But if the monthly falls below, I'm going to sound repetitive. This is looking attractive again, but I'm not going to say any more than that, given how much it's dropped. Now, the idea is, look, if this bloody thing goes from 67 back to 260, which is where it was recently, not going to say it's going to do that, although many a stock in history has done that. And JP Morgan said on the 17th of April, buy PayPal. They might be wrong. They often are. But I just thought it's worth keeping an eye on. So it's one of those bellwether companies. So like I said, there are many like Tesla and the others are bellwethers. So I want to discuss them. Netflix. General Electric, not one I bought. It was popular with the hedge funds. And the hedge funds were right on this. I was wrong. I actually thought when we started covering this at the start of the year, this is overbought and is going to fall. I thought that's overbought. That will eventually fall. It didn't. It just kept going up and up and up. Well, that will happen sometimes. And look at all this. You might say, well, Alpesh, what you should have done is just followed the analyst. No, that, as I've written in my FT columns, that isn't actually that useful or correlated to upward moves. It's just coincidence that this time all of them got it right. So I missed General Electric. Would I buy it now? No, it's overbought. Sorry, missed that boat. I just want to go through some other things. The information was shocking, 20% growth between 2012 and 2022. This is somebody who'd emailed me in December, and I've shown you this email before, and it goes to what we're trying to help people with. Over 10 years, she got 20% growth. Okay, in those 10 years, the UK markets had indeed gone up just slightly over 20%. So she was left 100K into 124. The NASDAQ had gone up that much. I'm not saying you just track an index, as I've already said, or blindly follow. What I'm saying is there were other opportunities. There were definitely opportunities if a whole index could do that, that she missed out on. And very often, UK pensioners are tracking the UK markets very often. Or their investment managers have sprayed and prayed. So what kind of returns are realistic? Is even 40% realistic? Well, it's going to require 9 individual things to replicate. And we don't know yet if 2024, this year, these 9 will replicate. I do not know. Okay, until after it's happened, then I'll know. First of all, I don't know if there's going to be a market tailwind like in 2021 and 2023. There is at the moment, i.e. rising monthly MACD, but we don't know if that will persist. Why don't we know? Well, because the Ayatollah called me up last week and said, yeah, Alpesh, I'm not so sure what I'm going to do. If I'm going to fire some more missiles and nuke with his secret nuclear program. And my point is, we don't know. If there's a tailwind, we should do well. If there isn't, we won't do as well. And we don't know if there is. We follow a process. High Sortino, high alpha stocks, well, that we can continue doing. UK is too small a market. Emerging markets are too small because you've got too few stocks. The 350 largest UK companies, 350, that's it. I mean, in the US, the S&P 500, I think pretty much hardly any of the 350 UK largest companies would fit even in the S&P 500, okay? Let alone the 10,000 other stocks that we look at. If you can go to cash in bad years like 2022, monthly MACD falls below its moving average. Simple, all right? I've just told you. If you monitor once a fortnight, because if you don't, then you'll just sink with the Titanic if you don't look at your pension at all. If good years make up for bad, in other words, you get an 80% year like last year when the NASDAQ was up 55%, and you get a 0% year like 2022, good will have to make up for bad. Croaky, that's from Goldman Sachs Wealth Management. If you hold for 12 months, because if you try and trade, you're going to get wrong-footed probably. If you just try and use the weekly MACD, you'll get wrong-footed. If sell anything which drops more than 25%, although I said could extend it to 30, 35, if when you look at historic times when it's risen, the drawdown depth typically hits more than that anyway, okay? But I certainly don't try and read the narrative and say, oh, I think it might be that on those things. that's why for us, 2023 is probably a year which will never repeat itself. I don't think it'll repeat itself this year, because I said at the start of this year, I don't think 2023 will ever repeat itself. It was just such an amazing year. The market was up 25% on the S&P 500. I can't take credit for it. And our US stocks, I buy from US, as you know, further filtered final, MACD, rising, quality 5 and special situation that we're in, just all coincided with just a great set of numbers: value, growth, income, cash flow, Sortino, alpha, lots of boxes ticked, rising MACD monthly and weekly for most of the year. That if that doesn't repeat itself, you won't get another year. It wasn't a typical year. For instance, 2022 was in cash for most of the year. I'm going to answer questions in just a second. Fred has held interest rates. Well, if you've watched me on LinkedIn and Twitter, you will know I've been saying that some of the biggest hedge fund managers who are expecting March falls in interest rates were wrong. I kept saying they're wrong. And in fact, I think I said on LinkedIn, please somebody screenshot this, when Pershing Square guy, who's the hedge fund manager behind Pershing Square, Bill Ackman said, oh yeah, probably going to drop rates in March. And I said back, I think it was in January, I said, nope, you're wrong. Somebody screenshot this. So yeah, they're going to keep holding them for longer. And do you know how I know? Because I'm a man of the people. I walk down bloody high streets, speak to companies. There's a lot of money being made. There's a lot of money being made. They're hardly about to cut interest rates. Age helps. But wait a minute, Alpesh. How come you had in your portfolio stocks which stank like that and others which weren't like that? Why couldn't you just pick big winning ones like this? Well, I wish. I'd then only pick one stock and I'd go to Ladbrokes with NVIDIA. I didn't know it was going to go up that much. All we did is we ticked value, growth, income, cash flow, Sortino. But Alpesh, if you did that for this as well, why is that one down and this one up so much? Because the stock market isn't science. It isn't physics. What we're trying to do when we tick all these boxes at the start of the year is ensure there isn't something stupid we've got wrong. So we're looking for undervalued companies which are growing, which are producing dividend yields and strong croaky and momentum. Yet that happened. Oh, well, that must be bad then. Yeah, so obviously you don't want undervalued companies. You don't want growing ones. That must be wrong. You don't want dividend yielding ones. No, that happens. That's an X factor. Well, you should be able to see into the future into that. Nope. Like I said, don't have a time machine. Don't have a crystal ball. We're trying to avoid any stupid mistakes. Okay? That's why we do that. And by the way, if you think there was a stupid mistake with that one, do let me know, because you could probably have forecast that one as well. Anyway, the return was 80%. That's not going to happen. Okay, regularly, let alone the 2 times leverage. You can see now 2 times leverage in Microsoft. I was somewhat bloody worried about continuing to hold in terms of my exposure. And you might say, well, you're a little pussycat, Alpesh. You should have tripled down on Microsoft. Yeah, like I said, risk is personal. So those are the ones from last year. Will it happen again? I don't think so. My job is not to forecast the future. My job is to make sure there's a process which, if there's a market tailwind, we have the ability to take advantage of that opportunity and fill our boots like last year. And if there isn't, and there's going to be a drop, then inch by inch, we stay in cash for longer. And lo and behold, the year's gone and we had our umbrella up all year long. That's it. Fund managers can't go into cash. You and I, as private investors, can hold cash. Let's say you plan to invest over 10 years. And let's say you make 20%, not the 10% long-term average, because you cherry pick and you pick undervalued companies which are growing with dividend yields. And you start with 100 in your SIP or ISA, and you add 1.5 a month. Then over 10 years, you'd have $1 million. That's what would happen. Now, sadly, it won't go like this because it's not a bloody bank account. What'll happen is it'll go like this, like that, like this. It'll be crazy how it'll move. Okay. But the idea is, that's when it becomes worthwhile. Yes, it's called compounding. Why does nobody do it? Well, because it takes a lot of time before you actually see any decent returns. 53% think the Dow will be higher than today's level. 30% say they're not sure. 16% say no. Okay, fair enough. Is Jensen's alpha the same as the alpha you mentioned? Yeah, you can use Jensen's alpha. By the way, because it's not mathematics, it's not science, the stock market. I'm going to ask you another question. Will Trump win? I'm talking about the presidential election. Okay, so I'm going to ask you that one. Yes. Whoops. Forgive my typing. Preview, publish. Okay, just asking. Read nothing into it, just asking. Okay, that is why. Now, this is showing what would happen to your returns if you got 20%, if you got 15%, if you got below 10%. Performance makes a massive difference. Of course, more money makes a big difference. Well, how are you going to get more money? Starting when you were younger makes a big difference. Well, how are you going to get a time machine? So short of getting a time machine and more money, and if you've got a time machine, you won't need more money. You'll have all the money in the world. The better thing to do is to move performance, even by 1%, 2%, makes a massive long-term difference. So I find focusing on performance a hell of a lot easier than trying to live longer or find oil in the back garden. And I say you can be overpaid fund managers. I found this, the newspaper, the original newspaper, I was cleaning out. We're getting new things built in the garden at home. And I found my storage boxes, which had this in it. So this is not just theory. When it came to practice over a 1-year period to beat this numpty, I won the whole competition, okay, which included brokers, fund managers, columnists, analysts, every single type of person, and the cat of the editor, random chance as well. Okay. It's very easy to open a SIP, ISA, 401k. You go to Barclays, have a look at these, have a look at Interactive Investor or Interactive Brokers if you want to keep your SIP in US dollars because there's the currency risk thing. PSG versus Dortmund, putting 3 times leverage on whatever you say. Do you know what? Okay. I have got subscriptions to Netflix, Amazon Prime, Sky, Disney Plus, Apple TV, Paramount. I drew the line. Another bloody BT Internet. They call it something else now, don't they? BT Sport sold to somebody else. So I won't be able to watch that match, I'm afraid. I'm going to miss it. But I'll tell you who I want to win. PSG. Okay, nothing against the Germans. Right. Be careful with name recognition and just giving it to investment trust managers. Ask them how they did in 2022 because they can't step aside. I have an inherent advantage over every single fund manager. They can't say to you and every single IFA, hey, this year you should just hold cash. So they will necessarily, every 6 years, lose 6 years of your pension. That's an extreme example. Meta, 6 years of your pension. They won't all perform as badly as Meta did that year. But what will happen is we can sidestep it. Simple rule, that MACD goes below that from an overbought position, sidestep. That's it. Okay? My 6-year-old son can do that. And it's not new. I wrote about it 25 years ago. So I couldn't tell you anything new like, oh, well, actually, no, you know what happened? I got a hotline to some inside information. Can't tell you that because you'd say, no, I read your book, mate. You said the same thing in 1997. So don't make out as if you're all clever now. You're just using the same process you used in 1997 with a different accent. Okay, so like I said, value growth, croaky, these are the things that are the most important to me. If you ask me what's the most important, monthly rising MACD and value growth income, 9 out of 9, 8, or 7. 9, 8, or 7. Why not just 9? Surely 9's better than 8 because it's not physics. Okay. If 9s did better than 8s all the time, we'd only have picked 9s. But 9, 8, 7s do better than 6s, 5s, and 4s. Okay. 12-month holding period, unless it drops 25. As I said, you might extend that if you feel your own risk appetite justifies it. I tend not to. So if it's dropped, I chop it off. Okay. In between, like with Microsoft, I got more risk averse. Well, why did you, Alpesh? It didn't drop 25%. Why did you get out? Well, I just told you today, earlier. Why? Okay. I've done this many times before. The factors. Most of my students will have about 20 stocks in their portfolio. The book you can download from alpeshpatel.com/links. It's this book of all the ones that I've written. That's a collection of my Financial Times columns. This is what Warren Buffett, Bill Gates own at the moment. Don't copy that. The reason I show you this is 50% of his money is in Apple. Basically, after their 8th holding, they've got less than 3% of the money in their 8th holding. Less than 3% of their money in their 8th holding. Okay. By the way, if you're one of my private clients, Coca-Cola. I'll talk about that tonight when I do the recording this evening. As you know, May the 1st, first of the month. I update the database every month for my private clients. And today's May the 1st, and we've got this. So it has been one hell of a busy couple of days since yesterday, collating all the data after the US market close, and my team. So we have a data team who pulls out all the data from the stock market, from the companies, from Refinitiv, all of this stuff. And then a graphics team who has to put all of this together and the presentations and all the rest of it. And then I've got to go through it all. So if I've got bags under my eyes, that's why. On top of which I took yesterday off, I was in Oxford. Cash return on capital invested, that's from Goldman Sachs. What they discovered is companies which generate the most cash return on capital invested generate 30% per annum. Not every year, not every company in that. So that's why I tick that box, but it's not as important as my value growth income, which looks at undervaluation, high growth, and dividend yields. Tell me if I'm missing something. This is somebody else's portfolio, which we analyzed, and a typical problem most people have is that they haven't ticked enough boxes. They get companies by name recognition and too many funds. Each one of those funds will probably have about 100 stocks in it. They've got spray and pray with their IFA. Indeed, scattergun effect is a term that somebody had emailed in and said this is the problem they had with, in this case, Brewin Dolphin. Okay, let me take you through. As I said, that then became the Holy Grail to simplify across 10,000 stocks. To do that for that reason, anybody can learn to be their own fund manager. The reason is this: it is like driving, not like brain surgery. So Naomi joined me after university when she was 21 years old. She worked for my company for 2 years. When she launches new funds, she references that in all her SEC filings. And then she joined Newton. Now she works at Polar Capital. Okay, so for 2 years she was my secretary, and now she runs billions. It's like learning to drive. As an English literature student who's a part-time opera singer, anybody can learn to drive, is my point. Okay, especially when you keep it really simple. Our job, or my job, which I found most fulfilling, has been to try and get people away from the St. James's Place that they're unhappy with, which is a FTSE 100 company with 900,000 miserable clients. No, sorry, they've got 2 clients who are happy and 899,998 who are bloody miserable as hell. I know because they keep emailing me, and that's a FTSE 100 company. Is to remove those fund managers who will never tell you actually we're crap, not because they're actually incompetent, but because they will only look at certain geographies. They will spray and pray. They can't go into cash. They won't have a big gene pool. I'll tell you 2 main reasons why I have a natural advantage over fund managers. One, I can pick from 10,000 stocks. They can't. They can only pick from the geography they've been assigned by their bosses. So it might be a UK fund. They can only pick from the style, value only, whereas we can look at value, growth, income. Surely you want to look at more things, not less. Okay. And they can't go into cash in bad years, because they have to keep 95% in equities. And as I showed you earlier, equities can have massive drawdowns, and those are the periods when you become ridiculously poor. If they drag you down like the Titanic in those periods and keep telling you, oh no, look, over 2 years, you got a 0% return, it came back. Well, yeah, except you missed the 150% rise that you could have had in that, and that was the year to fill your bloody boots that you missed out on. Okay. Why did we have Meta in 2023 but not in 2022? Very simple, I'll tell you. And it's a really good example which I like to show people because it happened. Why did we not have it in 2022? Because the monthly MACD was falling below its moving average. Why did we have it in 2023? Because by then it was on the approved list: value, growth, income, cash flow, Sortino Alpha, and one of the quality 5 anyway. And momentum wasn't falling. Simple, right? Really simple. And that's why we did it. And this I've been perfecting since I had hair, actually. I'm going to get hair again. And since I had slightly fewer triple chins, I'm going to bring red carnations back. So the idea is, well, can we revolutionize the asset management industry? I mean, other than doing this, doing these free webinars as part of my campaign for 1 million to teach 1 million people globally how to be better investors and add an extra 1 million to their pensions across their lifetimes, okay, is one thing. That's when you get older, you want big, worthy purposes as to why you were on this planet. But can we do it something else? Can we give this data to people. So I had the idea, well, what if we gave this data, created a company which we could get venture capital investment into, and then eventually maybe even float it, replace St. James's Place, but not be an asset manager. Let the private investors do it. Give them the data and the knowledge. If you've got data and knowledge, you can do everything. So that's the ambition with it. And that's how this all came about. That's interesting. 60% think Trump's going to win. So that is interesting. Okay. And then we got with people lots of likes. If you would like to have the data in handheld, now what we're doing until we get the first 250, I think I'm going to increase that to the first 275 because I'm not overwhelmed at all because the system's so good, the processes, is you will always have me as your tutor. When we go more global and have more than numbers than that, then in future, other people who join later will have other tutors. But for the first 275, they'll always have me for life. They will have no subscription charges ever. It'll be a one-off. In future, for later people, there'll be more as we go global. We've already got people in the States and in New Zealand, but most are in the UK, which is fine, but quite a few in the United States, in America. I'd say about 20% in America, 10% in other parts of the world, including Europe, and then the rest in the UK, because we look at global equities. And I want to change how people have been doing things. What I do on webinars is also give them 40% off the full price during the webinars, because I know outside of webinars, I'll be busier during webinars. I know it'll be fine to take on new people because I've planned for it, anticipated it. Like I said, lifetime updates as well. The overall ambition, maybe to float it, maybe to get venture capital investment, but certainly, I guess more recently I've said, because it's come to mind, is remove St. James's Place from a FTSE 100 position and steal as many of their 900,000 miserable clients. Sorry, 900,000 minus 2. They've got 2 happy clients. Simple as that. Because they're doing a bloody god-awful job. So Uber doesn't own cabs. We won't have the assets. You'll be managing your own assets, but you'll have the education and the data. And the education and the data and unlimited access to me, which you don't actually end up needing because I give you so much content and the process and the know-how that you don't end up needing it, is what we do. What do most people want? They want the one-to-one access to me, unlimited for life, which only comes for the first 275 people. And they want the data. And of course, they get the monthly updates, of course, with that and the videos and everything else. But it's the unlimited access to me. There is an online education program that goes with it. But most people we've looked at don't actually go through the online education. They do the one-to-one tutorials with me instead. And the way we looked at it is, well, if you got over your lifetime, even just in 1 year, a 20% return beyond what you otherwise could have done on a 500 SIP or ISA, you'd make an extra 100K. And so the idea is to make it into a no-brainer for as many people as possible. That's the idea. That's the website. I'm going to answer some questions while we take on new people. Labs, what I use. LOL, spray and pray with an IFA. I know. All right, rhymes. Alan Fink, you'll be back off to the Maldives soon. Then, no, the funny thing is people think I'm always in the Maldives, which it does look like it, doesn't it? I was there twice in a month. It's because I was in India once for work, and it's only 60 minutes from India, and once for to collect my parents who actually live here in the UK. So because I was going to India anyway, I thought, well, it's 60 minutes away. I mean, let me put it this way. If the Maldives was 60 minutes from London, you'd be there every month. Come on, let's be fair. And I absolutely love the hard rock, because it makes me feel like the person I'm not, a bit of a rocker and cool, and I'm just not that person, but it makes me feel that way. Do you even watch the TV? You're a very busy man. I'm not as busy as you might think. Remove Paramount. TNT Sport is good. I might take you up on that. I'm just fed up of paying so many bloody subscriptions, because I know if I get the sports, some bugger's going to create something else. To be honest, I don't actually watch all those channels. Family members do. Shared passwords. I'll tell you what I watch. I'm not kidding. YouTube, old episodes of Yes Minister. On Amazon, old episodes of The West Wing, and old episodes of Rumpole or Sherlock Holmes. And those are free. I know, because every time I think about watching anything else, I think, if you can't beat those 4, forget it. And I just can't find stuff which beats those 4. Jensen's answer the same. In case you missed, Alpesh, when the made private monthly videos come up. Oh, yeah, thank you. ASML. Mitesh, that'll come in the private thing because you're on the program. I'll do it tonight. Been previous question on how to calculate Sortino portfolio. Oh, I think somebody mentioned this. I haven't come across portfolio. I'll have a look at that. Thank you very much. And thank you for sharing, Peter. I think people might find that helpful. Thoughts on Levi's? But haven't changed. I still own it. There you go. In your Investing Champions video, you mentioned a site called Vuru. It's closed down, unfortunately, now. They keep changing. I'm sorry. Yeah, they closed Vuru. That was a really good one. I'd probably say, Dev, yeah, it's closed down. I'll have a think what might be useful. Email me to remind me, Dev. We spoke earlier, didn't we? Today. Email me and I'll think. But yeah, sadly, they closed down. It's really annoying. Simultaneously go deep. Oh, so that's all of them. Thank you very much, everyone on there. Okay. Whoops. There we go. Now I've got to just check. A few weeks ago, you mentioned Crocs to be in the special situations. Was it included? I can't remember. I'll have to have a look. So what happened? Let me put it this way. Let's say something was in special situations in January. You'll hold to 12 months unless it's fallen 25% or the MACD did what it did. That's it. You don't look to see, is it still there on, I don't know, valuation metrics. And the reason you don't do that is because you actually, don't forget, you want companies to be overvalued by the time your time is up, your 12 months is up. Now, you might hold them beyond 12 months like an NVIDIA or a Meta because they just keep going up. So why the hell would you exit? Okay, no, I not email you. Must have confused maybe another dev. Yeah, I spoke to a devrat earlier today. Dev, I'll have a think about an alternative to Vuru. I'm sure there is. I love looking for new internet sites. I'm a bit of a geek like that. I used to look at Levi's, still own Levi's. Yep. Rich, the standard settings usually the same as what Alpesh uses. Okay, Geddy, thank you. Oh, yeah. For the MACD. Now, this is interesting. People say, what do you use for the MACD? I kept my life and yours very easy. And it's in the books. I've done this for 25 years. I've even written that whenever I've played around with computer settings for different settings of the MACD, you win some, you lose some. So there was no point changing it. So I always kept it to the default, knowing that anybody could go on a free website and copy the same settings without having to tweak it. So it would keep their life easier as well. So those settings are the default ones. Exactly correct. 26, 12, and 9. Or is it 26, 14, and 9? It's one of the, whatever the default ones are. You've seen it on my screen all day long in this. By the way, you are the closest to the perfect private individual when it comes to investing. We got loads of great testimonials over the years in the books and everything else. And so I do the free webinars for my campaign for 1 million to teach 1 million people how to be better investors. Have a look at that website. You've got a ton of free resources, including downloading the book. No, I'm not even, must have, oh, sorry. Okay, I think that's everything. Have I missed anything? I think I've got everything on there. Sorry, it's really overran. I just had a whole load of great slides that I wanted to go through. So thank you all for being on here. Whoops, really appreciate it. Thanks for everybody who has signed up as well. Like I said, we've got more and more efficient at this to the extent that I thought it was going to take up a lot more of my time, the program, but it doesn't, because there's a process people are taught. It's a bit like learning to drive. Once people have learned to drive, they've been onboarded over the first 3 months. Are the trickiest time for them because they learn their risk appetite, which is usually not as high as they thought it was. They all join thinking, whoa, I'm just going to get these magic stocks which only go up. And then they'd say, well, actually, you know what? I'm not a 10 in risk. I'm more a 7 or a 6. I say, that's great. Now that you know, you'll actually, funnily enough, make more money because you won't take stupid risks. So you'll work out that actually I want to risk mitigate a little bit. So anyway, that's that. Got another question. Thank you. Thank you all very much. I think what I saw it for 21 was that price. Dev, the price has changed. Yeah, it's gone up and it'll be going up again soon as well, I'm afraid. So you're right, Dev. The price has changed. I think it went up in February and it went up in January and it went up last year as well. Any other questions? No, that's good. Okay, guys. Yeah, I think there's some football on, which, like I said, sadly, I won't be watching. Well, not sadly, I won't be watching. I'm going to, it's my parents' birthday. They were born on the same day in the same hospital. And I've been with them all day, and with the exception of this period now, and I think from 6 a.m. to 9 a.m. So I'm going to go back over there. Let me see. How do I turn off screen share? There we go. So see you all, and thank you very much for being on the webinar. And for those on the program, you'll get the private one tonight, probably about 10 p.m.-ish. Once the US markets close, I'll do the private one for you on the private Telegram channel with the detail on what my market view is, because it's Wednesday, so you get the updates. And all the other updated, don't forget the data's been updated today. So all of this has been updated. So is the PowerPoint executive summary, as it were, of the further filtered one. So all of this has been updated for you if you're on the program today, because it's the first of the month. Okay. So yeah, these are all, none of these, by the way, I'm showing you on screen, suit my portfolio, just so you know, in case you think he's showing all the ones he's picking. No, because they're not green across all 5. I think if something's going to be good enough to be my portfolio, it's got to be the best of the best of the best. And even then, can't guarantee it'll only go up in one direction. Thank you all very much. I'm going to call it a day. Thank you. Bye.